Hello, everyone. Thanks very much for joining us on a lovely sunny Monday morning. This is Talk 1, Day 1 of Gentleman's Journal Live. And it's an upgrade from last year, I think. This is an incredible space. So thank you very much for Philips for hosting us. And thanks all of you for giving us an hour of your time for our first talk of the series. This is startup investment and how to get it. And we've got three people here who know exactly what they're talking about because unlike a lot of people in this industry, I think they've unusually been on both sides of the bargain, both on the startup and the founder side, but also, of course, on the funding side. So, why don't we run down the list? We've got Harry Stebbings, who did have some very, very natty sunglasses on, but they've now disappeared. Harry is from 20VC, a venture capital company born out of his incredibly successful 20-minute VC podcast, which he started when he was 9 years old or something like that. Now we've got also Harry Destecroix, MBE, which is excellent to have an MBE up here, founder of the Science Creates ecosystem and managing partner of SCVC, the home of deep tech. I had to ask Harry earlier what deep tech was, and he said the word quantum to me, and I instantly knew less than when I started. But he's going to explain all of that to us. And then Dinika Mahtani, partner at Cherry Ventures, and before that, Dinika was an executive at Uber Eats EMEA, and also launched jump bikes in the UK, Uber's bike arm. Those were great. The big orange ones.
Red.
Red.
Crimson red.
Were they? Okay. Crimson red. Wonderful. So let's get into it. We're going to talk for about 35, 40 minutes, and then we're going to open it up to the crowd. And there's some chairs up here at the front, but it's quite cool to linger at the back. I get it. It's fun. Okay. So I think let's start with a general question about the...
You have the most fantastic interview style.
Well, it's improvisational. Let's just say that.
After 10 years of interviewing, I still don't interview with this wonderful, loquacious elegance that you have.
Good use of loquacious.
So much.
We could go back and forth on our interview styles for a while. Let's talk a little bit before that about the kind of the world of startups. It seems right now that everyone's a startup. Everyone's got a personal brand. Everyone wants to be a founder. In the kind of the business ecosystem right now, startups are the sexiest, coolest thing. And we've all got a side hustle and a project. Why do you think that is? Why do you think we're in a particularly entrepreneurial moment? Or perhaps we're not? Who wants to take that one?
I think a lot of young people have made a lot of money in the last couple of decades, and I think films like things like Facebook and films, it's really become popular, and I think that has changed culture, and I think a lot of people it's on their radar. Whether it's a good thing is another thing though.
I just think young people want to have impact, and if you want to have impact fast and build something incredibly meaningful without bureaucracy and without process, the best way to do it is to build a startup. The best way to make plenty of money quickly, often now, is a startup, especially with like rising secondary sales. It doesn't mean it's easy by any means, but if you want to have impact, you want to move fast, and you want to own your own time, which I think a lot of young people do, the best way to do it is a startup.
Absolutely.
I think the barrier to entry is also extremely low, and that, whether it's cost, whether it's access to other people who want to build with you, who want to come on the journey with you. And then the last thing I would say is pop culture. I think pop culture has everything to do with, bringing to light some of the really incredible success stories of the past decade, but some of the epic failures too. And for good or bad, I think this motivates really young people.
No, I wouldn't be here if I hadn't watched a movie. I watched The Social Network when I was like 13 years old, and I saw Peter Thiel invest in Facebook with Clarion Capital, his hedge fund. And I was a kid in London, and I was like, wow, that's what I want to do. And I don't know if I would have been exposed to it at all had it not been for that. And so I totally agree with you on pop culture.
I think there was a massive uptick from that movie, and that's why I was saying, we often speak with governments and things like that, and so actually probably speak to the film industry if you want to drive more entrepreneurship.
Yeah. So I'll ask some actual grown-up questions, but who would play you in the movies of your own stories, perhaps? Is it fun?
Ryan Reynolds. I mean, he's been calling.
Obviously.
I was just ignoring for now.
Okay. Harry, I can't believe we're at this level already.
No.
I thought about mine. He's like, no.
Dinika, have you ever thought about that?
I'd probably like to play myself.
Okay, that's the best answer.
Now I look like a dick.
So yeah, I mentioned before that you all started out in startups before going to the funding side of things. Could you each give us a little bit of a kind of overview of your journeys, how you got to where you are now? Dinika, we'll start at the end with you.
Of course. So very vanilla, plain start to my career. I was an investment banker in New York, started at Goldman and then moved to Barclays. At Barclays, I became exposed to a lot of technology companies, everyone from Huawei to Reliance Jio before they started owning all the telecom spectrum in India, and then Uber was one of my early clients. Raised a bunch of capital for them. This was after the Series C, and then their team in San Francisco was like, "We have a role in Amsterdam. Do you want to take it?" So I moved my life to Amsterdam. I'd never been there before. Took a 75% pay cut at the time, but it was an incredible ride. Was there 4.5 years, and that pace of growth, being in the same room as people who were 10 times smarter as you, having access to, board level discussions, really wanted me to be sort of part of that for the rest of my life. And sort of started angel investing and in sort of a lot of brilliant people that I worked with. And sort of that landed me at Cherry 4 years ago. I sort of lead our UK team. It's a German-founded fund. We invest across Europe in early stage founders.
Super. Harry D.
Yeah, I think I fell into it probably because I'm just deeply unemployable. And I was doing a PhD at Bristol, and I was just obsessed. I got a very lucky project. It was 20 years of research and decided to do a spin-out company in 2014. And then it was around insulin and diabetes. And the struggle of trying to do that, I was sort of up against the whole department and universities. There's lots about spin-outs. I founded another company in 2015, which became Science Creates. And we got a super early exit in 2018 to Novo Nordisk. All of a sudden, I'd made a ton of money and started angel investing. Then I got really annoyed angel investing with just being on the other side of the fence and wanted more capital, wanted to really work with founders and support them. So ended up raising a fund in 21, and now we're on fund 2 in 25.
Lovely. Harry?
I mean, I've never actually had a job, so I mean, it's very kind of you to say that it worked before. No, I hadn't. I actually started the podcast from my bedroom. Literally had like $50, and then 4 years in, I raised an $8 million fund, and then I raised a $140 million fund. And
I think aren't you missing some steps there?
Well, I mean, it's
$50, $8 million.
Yeah, I know, but it's like Cliff Notes.
Okay, fine.
The worst thing's a long intro. One big lesson, when you get on calls, and like 5 minutes in, they're still going, and you're like, oh. I don't care where you went to university. And so it's like, number one rule that you can do today, break your life into like 3 chapters. So it's like, number 1, saw Social Network, fell in love with venture. Number 2, when I was 18, started the podcast from my bedroom with no money and no contacts. Number 3, raised $400 million like 10 years later, and here we are.
Okay, that's good. Very
Any
good.
questions?
It's interesting you say that, because I think we have an idea once upon a time of getting investment for a business. You'd go to your bank manager maybe, or perhaps some wealthy person you happen to know. It was a very, very different thing. Even 30 years ago, raising money was very, very different. Now the world is filled with all sorts of acronyms and different funds and different ways of doing it. How has the startup ecosystem changed most significantly, do you think, since, I guess, maybe the millennium?
Happy to take it. There is a shit ton of cash.
Right.
Like, there is so much money, and there is very few generational defining entrepreneurs. I think that is the biggest problem that I face today, is that for every one founder that we want to invest in, there is literally 20 term sheets. And so to your point on how's it changed, massive influx of cash. Yes, of course, supply side of entrepreneurs has got way higher, but quality entrepreneurs that are going to change a generation, I would say it's actually still stayed the same. I think that is relatively flat. And in Europe, I mean, it's night and day change. Like, 20 years ago, there was basically nothing. It was like your three eyes of the world. Now there's 50 funds in London. And so everything's got more competitive. We're taking also now, we're taking more risks than ever. Revenues mean very little in an AI world. They're so transient. Product market fit is so transient. Hell, we're all just fucking gamblers at this stage because there is so much risk baked into venture because you have to win. But the outcomes are so big. It's trillion-dollar companies. Shit, you got to play the game on the field. Sorry, I always have this energy.
I love it. Dinika, what about you? What do you think?
Yeah, I think the core technology has been the thing that's changed the most in the millennia, right? I think right now you can be, two girls or guys in a bedroom and build a company that does $1 million in revenue in 4 weeks. I don't think there's ever been a time where that's been possible and where it's actually happening. I think the core technology change and what you can do with AI and AI-enabled technologies has changed and will continue to change the way our jobs and the way entrepreneurs see sort of their next 10 years dramatically.
Wonderful. Harry?
Yeah, I mean, echoing what Harry said, there's a lot more capital in Europe now. There's pretty much nothing, 20 years ago, even 10 years ago. There's been huge influx of capital into Europe. And then, there's a number of advanced technologies that have come to fruition in the last even 5 years, across, everything from genetic sequencing through to, CRISPR. We had the first drug approved the other year. And then, of course, you've had this, all of a sudden, AI has been sprinkled across everything, and everything's going even faster. So I think there's a lot more complicated products and businesses can be built now with a lot less capital. And I think we're going through this sort of pendulum swinging to sort of maybe a bit more towards the hard tech. And I think the last decade or so, it's been a bit more mobile. And I think we're now getting into really, really interesting things that these technologies are kind of touching everything.
I think a lot of investors are going to lose a lot of money, though, in the swing to hard tech. I mean, there's so many that bluntly are going in without much of the base knowledge. And I'm seeing bio, I'm seeing defense, all of these kind of frontier technologies where they just are YOLOing in from enterprise SaaS. It's going to be bad.
100%.
Which I think is good for the space, though, because you need that cash to develop the space.
And there's going to be a lot of Theranos, I think. And I think it's where people are going into really advanced technologies without the right to sort of understand it. And there's different economic principles at play here. So I think it's about, there's a lot of people who are being pushed to deep tech who probably should be a bit careful.
But I think it's so important that we're doing it because, the biggest worry for me right now is, we are fading into complete irrelevance. Sorry to, ruin the sunny day and beautiful setting. But, China and the US are kicking our ass on AI. They are working harder. They are moving faster. They are far more advanced. And we're kind of sitting here enjoying the sun and taking in the espresso. And we're kind of not realizing just how fucked we are. No, I'm being serious. It's, really quite worrying. And we started this thing, Project Europe, which is this Teal fellowship, but for Europe in many ways, where we give $250,000 to crazy, ambitious young 18 to 25-year-olds. We have to inspire the next generation. Otherwise, Europe is in deep shit. Cliffhanger.
Okay. That's the takeaway from this. No, I'm sure there's some positive stuff as well. What is AI the thing that you're seeing most startups now? Is that the biggest area of growth right now in the startup world?
I think AI is a tool, and it can be applied across many verticals. So I think it's sort of, there are a few pure AI companies, but it's sort of lots of people leveraging AI with other technologies and expertise. So it's kind of, AI can be used, we all use computers and phones for pretty much everything, right? It's just a very cool way to get amazing functionality in so many areas. So I think, being careful just to say, I invest in AI is quite, unless you're doing foundational models or the base compute, it's sort of everything has AI. So it's like saying everything has a computer.
It's like cell service. You need the cell service to get Uber, and you need it to get Deliveroo. Are they cell companies? No, they're logistics and food companies and whatever. But they leverage cell signal to let you buy on them.
Sorry for making fun of you, but it's are you investing in websites, 10 years ago? That's kind of what the question is. You're not really investing in AI. You're investing in, the thing that the technology enables you to do like 100 times faster or 100 times better, or change an entire business model, or move software into complete irrelevance.
Like just like we have a media company where we have research teams. I saved $500,000 in one chat GPT update. Like one update, 500K back in our pockets. Why? We had 3 researchers. Deep research, thank you very much, done. That was it. And everyone's like, well, it's happened before the agricultural revolution, the industrial revolution. Absolute shit. The speed of transition is completely different. Completely different. OpenAI changed one thing. They push one update, and you have generations that are removed. Before, it took years for manufacturing equipment to be brought in, PCs to be brought in on master workforces. It was completely different, the speed of adoption. And this is something that we also need to equip us. Sorry, I wanted to go on a positive note. But we're not equipping ourselves for, which is bluntly the mass unemployment that's going to happen in the next 24 months. No one is ready for this.
He always ends on these real big dramatic notes, and I'm not sure how to come off them.
Say something wonderfully elegant. Just use your arms.
But yes. So let's go to the slightly softer side of things, away from the technology or the type of business. What type of people do you each like to invest in? Or does that matter less and less now, do we think? Dinika, who do you like to work with when you're at Cherry Ventures?
I mean, of course, it's everything that matters. It doesn't matter less and less. I mean, that's, with the technology changing, that's 70 to 80% how, I make decisions. So what do we like? Entrepreneurs and founders with a huge bias to action. Entrepreneurs and founders that aren't afraid of thinking big, but conveying their ideas immensely big. And entrepreneurs and founders who also understand that the journey is lonely, it's going to be a roller coaster, it's going to be extremely hard, and that they need to be extremely resilient, sort of going head into it. And I think sort of the combination of that gets me really jumping out of bed.
See, we look for 2 things because we're very focused on the advanced technology, and we think that can't shift. First of all, we're looking for a real scientific breakthrough, something that could actually create a whole new category of product or business that's super defensible. And then we're looking for that founder that has insane resilience. I think what we look for is childhood, and really looking for kids that were building things, from a very young age, who are obsessed with how things work. And I think it's that constant on, you can't switch off, and constantly wanting to learn mentality that you see in founders, which often you can see in childhood. So it's childhood mixed with being very lucky and a big breakthrough and being in the right place at the right time.
Our job is immensely easy. Our job is to invest in people, period, at the early stage. And everyone's like, it's difficult to pick founders, and how do you pick founders? It's so easy to pick founders, actually, I think, because you just need to look for the most misadjusted ones, bluntly. The ones that are incredibly insecure, the ones that cannot not do something. You feel this, intense urgency, this unhappiness with the way that something is today. One of the best investors in the world told me the best founders make you feel uncomfortable in the meeting. It's not an easy and enjoyable process, but you feel that intensity. I've interviewed 1,000 founders who built billion-dollar companies, and I asked really 3 questions that I think tell me a lot. Number 1 is, talk to me about gaming. And do you game? The most successful founders, 92% of the time from our research, have been involved either in clans or leading clans early in childhood. Clans or leading clans, far more important than whether you went to an Ivy League university. Number 2, did you move around at all in childhood? Moving around in childhood very often aligns to the success of a leader. You're forced to assimilate with different cultures, build relationships fast, move on fast, very, very important. And another one I always ask is, who's your hero? The worst people are Elon Musk. And the best are some obscure inventor who invented some light bulb filament thing that no one really knows about, but it actually powers the light bulb, and it does this, and they're always the best. Those 3 questions will tell you so much.
So yeah, that leads me on to my next question. It sounds like you've partially answered it. With all these things, we think that it's a very hard science. We think it's data-driven and analytical. It sounds like what you're saying, Harry, that a lot of the time, the best decisions are made on intangibles, on gut feeling almost. Is that fair?
Yeah, 100%. But this is also a real art. People won't just tell you, I was bullied and broken as a child, and my parents were terrible, and I'm an alcoholic. They don't just say that. That's why I think doing the interviews in my past has been so helpful. You have 5 minutes as an interviewer where you really need to make the person feel safe. They need to feel like they can tell you anything. If you come in as a VC with your notebook and your glass-doored office and you're like, hey, how are you broken? It's like, it doesn't quite work. But when you unlock that and you say a little bit, you know what, I'm struggling with this, and you make them feel like they can open up to you. You know, it's a brilliant, I think, Maya Angelou quote. It's not what you say, it's not what you do, it's how you make people feel. And you need to make the founder feel like they can bring anything to that meeting, because the only way you're going to get the data to make a decision comprehensively is if you have as much data as possible. I think that's really important. It's like something that no VCs work on. How many VCs, if anyone's pitched VCs, are like, it was like, I felt like I could open up and be myself in that cold meeting room with Fiji water. I mean, Jesus, it's not like the most warm environment, is it? Sorry.
Harry, what about you? What percentage of your decisions are gut versus head?
But I think, especially being a former founder and now having another partner who's an exited founder, I started out very much science, and now I've only been in venture 5 years, and it's way more art, and it's way more feel, and it's way more of the right people. And what we try to do is just be careful who we get in front of before we've really looked at the background and then assess, so that we're not biasing things. But I think we bias things very, very early. So you really, really like someone, you want to sort of make sure they're kind of in the right ballpark before you get into there. So what we've done is try to do a lot of really what is our strengths as a fund, what are we good at, what are we not good at? Because if you can get in front of the right founder, they can convince you to invest in anything if they're really good in, and maybe you shouldn't be doing it. So we need to sort of say, like, do we have a right to be working with this founder, to help, to advise, or even, hopefully just stand back and let them kind of do everything?
What about you, Dinika?
I mean, so we're all early stage investors, and I think early stage investors, I'd say up to Series A, bias heavily towards the entrepreneur. But I think there's room for much more than that later on in the evolution of the company, right? Where when there is actual revenue and there is things to look at. Oftentimes for us, there's not much to look at, which is why you have to heavily bias to a founder, sort of why they want to build this, why they want to change the world. So I agree with all of that. I think that makes sort of 60 to 70% of the way we think about it. However, to your point, if we meet an incredible founder and he or she is building in space tech, I mean, we have to do the work as well, in order not to fund potentially the Theranosis of the world. So I would say we bias incredibly highly towards the founder, but it's not just that. And so depending on sort of what they're building, we do the work and sort of understanding why them, referencing sort of the hell out of them in terms of, how much they've accomplished in the space that they want to build a lot of times. And also, going deep into the tech where there is IP and strong tech.
Can I just jump in? I think I totally agree with all of that. I think challenges, often references can be very dangerous. They can be very misleading. If you did a reference on me from, like, I did have one job once. I was an entrepreneur in residence, and then they would tell you that I was utterly useless. I was 18, didn't know what I was doing. But they can be misleading. Often it's in a company, you're starting a company. It's very different being an employee to being a founder. I do what I call the Tokyo test, which is actually, I try to walk a marathon with the founder. And it's not quite the distance from London to Tokyo in terms of flight. But after 6.5 hours, you've basically exhausted all possible conversation topics. And so you get into topics like, if you were to write a book, what would it be called? And most random topics. And that's where you see their brilliance, in the extended periods of silence. I find it actually most valuable. And sorry, just going back, I think 3 things matter when you're seed investing. One, is it a generational defining founder? 2, are they directionally correct? Are they selling pillows? If pillows, going to be hard. If it's sales, analytics, I don't love it, but it's directionally okay. And then number 3, is it a deal space that I can make work? I'm not going to invest at a 200 million valuation for a pre-seed company. It's just not my business. That's what General Catalyst and Lightspeed are for. No offense. So that's what that game is. So 1, founder, 2, market, and 3, deal directionally in play.
Yeah. And on the other side of things then, what are the kind of the red flags that founders do? They might think they're doing great things, but they put you off. Perhaps there's a lot of founders here. Are there any red flags you think people should avoid? Any phrases perhaps, or ways of going about things, Dinika?
I'd say a red flag whenever we meet a founding team is only one of them speaks, and the other is dead silent, not a word to say. I understand why that could be the dynamic, but we're backing sort of oftentimes a team, and so we have to assess the team. And so just the dynamic between founders when they have a founding team is also something to really keep in mind when you're talking to investors. And then I would say, know who you're speaking to. I asked my team this question last weekend. I was like, what's a red flag when, a founder talks to you? And a female analyst in my team was like, well, they shouldn't flirt with me on the first call. It's happened many times before. And so that does happen, and it happens frequently in the industry. And so, yeah, just two of those top of mind.
That never happens with me.
Well, first, we invest in deep tech, so red flag is if when a founder can't explain the technology. So we want deeply technical, obsessed, people. So non-technical CEOs, it's just we won't even look. So that's the first thing. And then I think it's, first of all, it's sort of lying, but you can kind of, entrepreneurs, they've got to sort of push the boundaries, right? That's sort of, how it works. But it's sort of when it's really obvious. So it's sort of unsophisticated lying. It's sort of, come on. And then at the same time, I think if they haven't kind of done their research and they're kind of, not going into the detail, and they're kind of, everything's very, very high level, and they're kind of, it feels like they're trying to sort of scoot around kind of certain things. So the ability to go deep, and also to go off piste. So, throw the pitch deck out and go anywhere you want, and can they follow you? Can they go into, everything from, IP all the way through how they're going to build the team to obsessing on the competition. What we look for is that there's an incredible breadth. They can go anywhere, or you can just go, talk to me about the state of the economy, or they're just interested in everything. So you're looking for that kind of, is this person just constantly reading, constantly learning, and able to kind of go left or right. So that's what we do, is sort of just tear out the book and go off piece and change the order up. And how do they cope with that? They've got that mental agility.
Let me ask you a provocative question. Is $1 billion outcome a good outcome? Is that a great outcome in venture?
Yes.
No. Okay, why entry value? Like, you will probably have 10% when you start. Dilution is very real today. You now have 5% on exit. Great, we sell for $1 billion. Now I have $50 million. Wow, that's 12% of my fund. I only need another 8 of those. It's not enough. It's not enough. Cherry is a big fund too, similar size to us. It is not enough. This is the biggest lie in venture today. $1 billion does not solve the problem anymore. We need $10 billion companies. Have to have $10 billion companies, otherwise this business doesn't work anymore, number one. Number two, worst thing, the next company I start. No, I don't want you to start a next company. I want you to build Spotify for 30, 40 years. This is your life's work. There is no other thing. I'm going to do 20 VC till I'm like, Warren Buffett style if I can. Like, this is the unwavering journey of your career. This is the last, my favorite one. If I had like $1 for every time I had this is the last round of funding I'm going to need, and I'm going to be profitable. Never happens, promise you. Terrible. Also, like you said about other people not talking, like, don't bring other people respectfully. Fine in the subsequent meetings, but it's about building a connection early with that person. It's awful when suddenly 3 join and you're like, oh Christ, I'm doing like a panel assessment of these people and I'm unable to build a relationship with them. No, don't do that. Also, get people on WhatsApp. The single biggest lesson I think to success in business is get people on WhatsApp. They're like, what? You build a personal relationship so much quicker. How we fundraise, I think effectively, I'll meet a great university endowment. I'll have the chat at the beginning where they say their son loves Manchester United. And then I'll be sitting at the weekend at Stamford Bridge and Chelsea will be playing Man U. And I'll take a picture and I'll send it to the CIO of the endowment and be like, hey, you got to come next time you're in London. Straight away, all the 50 managers have pitched him that week and like, pitch decks and boring shit. He's like, that guy, that's my guy. I like him. So important. People have to want to work with you. People forget this.
Okay, wonderful. WhatsApp. We should put your number up here so everyone can add you on WhatsApp. Dinika, one of the sort of tropes of modern startup culture is this idea of purpose or even mission. and these very grand sort of mission statements. We want to change the world through selling burgers or something like that. How important to you is backing a founder with a sense of real purpose, and how can you tell when it's sort of tacked on or fudged in some way?
Yeah, I think I'll use the example of myself. When I joined Uber, I drank the Kool-Aid every day. I was addicted. There's nothing more that I wanted to do in my life than make this company successful. And I had 2% of equity in the company. But every day it was all I did, from the time I woke up till the time I went to bed. And I think because I felt that so immensely in my experience, it's not easy, but it's something that we often look for all the time. So I think that's a very important part of how a founder conveys themselves, how a founder thinks about articulating their journey, their motivation, their purpose, but also what that means in terms of how they want to lead a team. And that's what I saw at Uber. Everyone was drunk on this Kool-Aid. Everyone was moving in the same direction of wanting to disrupt something. It was bigger than them. And when you talk to companies, Revolut, even companies that you might hear about in the news, like 11X, companies that have gained a lot of fame, infamy in one way or another, all of their employee bases were either full on the mission and the journey, and I think that's what you really want to convey. So the entrepreneur needs to embody that, but I think what's more important is, are they going to be able to do that for 100, 1,000, 20,000 people? And that's the real question.
Harry, what about you? How important is mission to you?
I think it's along similar lines. It's about trying to get the best out of the team and getting focus. So when it comes down to it, it's incredibly important that the founder has that kind of magnetic quality and can really drive the best out of people. And you want people within the company to be extremely driven to achieving the impossible, because most of them fail, right? And the people who are winner are the companies that are obsessed, and the whole team is obsessed. And there has to be a founder that can unite the team around that and drive just outsized results.
I think mission's a bit boring, to be honest. People have these mission statements, and quite often it's like Zoom. I think it's like make the world happier. Who's going to take the counter? No, I want to make the world much more depressed. No one. No. It's ridiculous. You've got to have a contrarian stance on, actually, we believe the opposite. I think the best founders understand that the best companies are not products. They're not even brands. They're movements. It's very different. Nike is a movement. It says the world is an athlete. Everyone is an athlete. Are you part of that movement? It's so important, and I think that's what the truly best understand. Take a really nerdy one, Atlassian. Atlassian, a $50 billion company from Australia, never ever built products or brands. It built communities and movements of developers who believed that their way was the right way to do it. Build movements.
Build movements, wonderful. What are the cliches of the startup world that you guys hate? What do you hear in pitch after pitch or conversation after conversation which you wish we could just delete? Phrases or anything, really?
My investor said I should do XXX.
Okay.
Throw that out the window.
Why?
You're the entrepreneur.
Yeah.
You're closest to the customer. I think there's a perception of the side of the table that we're on, and that we're somehow smarter, better, more capable, know all the answers. And I think that entrepreneurs who believe that need to change that way of thinking. Okay, great. We'll avoid that one. Harry?
Around similar lines, I think, over-reliance on advisors, other directors, and I think it's I think sometimes, especially if they're younger and they've got older people on the board, I think there's a reliance to sort of go into that employee mindset. I think that's really, really dangerous. So that they've got to be able to ignore 98% of all advice and even get rid of people within their team that kind of aren't working, and they should outgrow everybody. So it's that kind of real kind of, strong opinions, loosely held kind of mentality.
Definitely.
We live in this beautiful world where you can email literally anyone, okay? And in a world where you can email anyone, the way that you package yourself is the most important thing. And I'm just constantly in awe of how badly people package themselves. And what I mean by that is, we get loads of cold emails. Jesus, they're 5 pages, and they're a nightmare. 3 things. Why is this person relevant for me? So, hey, I saw your investment in X. Okay, immediately why they're relevant. Saw your investment in X, and I know that you care about why. So number one, why that person you're emailing is relevant. Why I am great, and you should take a meeting with me. I'm building the best sales analytics tool. We've scaled to $1 million in revenue in 3 weeks, and we have Danone and Nestle as customers. And then number three, what I want from you. I'd like 15 minutes to show you the product and walk through our pathway of expanding to the US. I'll meet you anytime. Boom. Everything is a game of packaging, and people just don't package themselves well.
Excellent. That's very good advice. Before I open this out to the crowd, you've all had huge successes, and there's probably many, many more, hopefully, coming down the line. But I want to talk about some of your misses, some of the opportunities that were perhaps put in front of you that you passed on, and that you regret, and perhaps what you've learned from any of those misses. Who wants to start with that one?
Yeah, I'll go with a recent one. And maybe you guys met the founder of an AI tool called Granola. I use Granola every day in my life. I think it's a great product. I met the founder in person, and then to me, personally, it was another AI assistant that he was pitching. It was the easiest pass in my life, right? He was a great guy, but he had no materials, no deck. It was him or nothing. And I was thinking to myself, well, he's really, really interesting, a really good guy, but how can I bring this AI assistant with no deck? And I mean, he had a good exit as well, so calibered individual. But I think that's the difference when you're part of a 5-person partnership and you're thinking, okay, so I need to get sort of at least three votes if I want to back this guy. And so for me, it was a really easy pass. I was like, there's no way this is going to pass. And I'm obsessed with this product. I wish I was part of their journey. I wish I backed the entrepreneur. And this was close to 3 years ago now, 2.5, 3 years ago. I've emailed the founder, we've kept in touch, we've stayed in touch, and it's a big, very recent miss that stings me every time I use the product, which is every day.
Wow, okay. And the lesson from that, I guess, then is back the entrepreneur, probably.
Yeah.
Wonderful.
Or change decision-making structures. Like, I would never have that decision-making structure. Like, I need 3 out of 5 votes. My EA can make an investment. Like, I'm being serious. My EA is super in touch with a lot of what happens in consumer. Like most decision-making structures in venture are fraught with politics, which then worsens decision-making, respectfully, sorry. I said it, not you.
Harry.
Funny enough, I was going to say, Fund 1, I think, as I was getting into it, I was an entrepreneur, I was going into this sort of finance, so I didn't really believe that I had any right to be doing it, I just wanted to. And I had way more of an external structure around the fund, and I really wanted to make an investment, and I didn't, because one of our advisors was kind of strongly opinionated, and I thought it was completely wrong, but I wanted to keep the peace, and that was a bad mistake. So Fund 2, yeah, there is a kind of, if a partner wants to do a deal, it's up to them, even if everybody vetoes it. So I think we have a structure now, whereas if you really want to do the deal, we can tell you why you're an idiot, but you can still do it. And I think that's really, really important. It's not about consensus. I think if someone's really wants to do it and they're really excited, they should be able to do it. And then finally, we focus very, very early, so we haven't really missed anything that we haven't wanted to invest in, which is actually probably more of a function of our sourcing not being good enough. And that's what we're really working on at the moment, is that we shouldn't be in a situation where we're not getting into, we should be missing some deals, and we've not really seen that yet, but we're pre-seed, we're quite niche, pre-seed seed, and we're looking at a lot of university IP. So, there's less competition what we're doing.
I sometimes debate whether I would have done better if I'd just invested in every single company I've ever met, because I've missed some bangers. I mean, like you said about Granola, we were the first investor to meet him, and I remember, this one pains me, we've got a screenshot. I messaged our partner, Kieran, who found it, and I went for a drink with him on a Sunday evening, and I responded, he really liked it, my partner. I responded, fuck me, set up a Just Giving page for this one. Fuck. That is an amazing company. And he was amazing, to be fair, but it was like, to your point, he didn't even really have an idea at that point. It was like, notes is something, knowledge is something, AI is something. And you're like, okay, that doesn't give me much. That was one very painful one. Deal, which is now a $12 billion company. First round, didn't do it. Came back the second round, didn't do it. Third round, didn't do it. I mean, I don't think he came back the fourth time. We just became friends. I mean, that's like a multi-$100 million mistake. Flexport, the logistics company, when I was like 19, he was like, hey, dude, do you want to invest like 25K at like a $6 million valuation? I don't know, it's like a $10 billion company now. That hurts a lot. Another one, Vanta, SOC2, which is like a $5 billion company that Sequoia is very, very kind of all in on. Turned down the pre-seed at 12 million because I thought, SOC2, what is that?
What is that?
It's a form of compliance.
Okay, yeah.
It's like ISO 27001. You know that one?
Yeah.
Yeah. It's great. So it's like one of the kind of core compliance pillars. But I was like, the founder was amazing. This is why, like, I am the biggest. Like, everyone laughs at me because it's being recorded. So bugger, I'm in trouble. But like, I don't know what a lot of the companies we invest in do. I don't care. I really don't. Like, it's going to change. The market's going to change. The product's going to change. I want to look you in the eye and know that you are unwaveringly ferocious, that you will be hit 50 times and go, I want to be hit again. And to your point earlier, everyone wants to be an entrepreneur. Yeah, they shouldn't be, because there is this like 0.5% of people that are actually meant for it, where you see that eye of the tiger. That's like the only thing I care about. I will literally never ask about their company in a meeting. And actually, it's a real, like, I think, strength, because then they come out of it and they're like, wow, that was really different to any other VC meeting where they asked me about market size or pricing or any of this crap. It's completely different. Tell me about your siblings. The way that you describe your siblings says so much about how you describe yourself. My brother's great, but he's not very ambitious. He doesn't really give it everything. Do you know what I mean? That tells me.
Met my brother. They're all very lovely people. Wonderful. I think that's great advice. Well, let's not get too psychoanalytical here, but maybe we will, because it's now your chance to ask some questions for these guys. Anyone got a burning question they'd like to ask Harry, or Dinika? Oh, hello, right at the front.
How do your funds not just become another feeder to big US companies? So, like, any scale founder, all they're really spoken about is like move to the US, get to the US. Like 9-figure exits in the UK are considered like big. Like, I totally agree, UK's fucked. How do we end up in an environment where actually it's not just this early stage capital where funds flying in, but also that you can build big companies here and our stock market doesn't suck, and that you can actually scale something which is meaningful and globally important in the UK?
Can I take this one?
Sure.
Yeah, London Stock Exchange is fucked. Yeah, you can't fix that one really in any short time period. So I completely agree with everything you said there. I honestly think you just have to work within the parameters that you have. I think you use arbitrage, you build engineering teams in Europe. Often the retention's higher because there's not so many good places to go. The engineering quality is very high. You build enterprise sales teams in the US as fast as humanly possible. You sell in the US to the US 100%. I think there's no avoiding that, and I think we just have to embrace that. If we're here to make money, and we're here to make money in the best and most efficient way, you've got to sell in the US, you've got to sell to the US, and that's how we do it. So I totally agree, and sadly, it's like work within the parameters.
Anyone else want to add?
Oh yeah, it's not our problem to fix, but 100%, you've got to be in the US with these companies, and I don't know how the UK can solve that, but I think you're going to need to be in the US with US investors at some point. And the history so far is it's been 150 billion of companies created in the last 50 years in Europe. It's like, how is it 30 trillion in the US? So it's just, we've lost.
I'd like to do something. I'd like to take over the London Stock Exchange, give Nick at Revolut 5% of every IPO for the next 5 years if he lists in London. The only fucking thing that matters is where Revolut lists. It's not going to be in London. If he lists in London and he brings a $75 billion listing to London and he says, in the London Stock Exchange, we've got some hope. And only just hope, but then we have some. Otherwise, we're fucked.
Dinika, what do you think about the state of London?
So I think your question was more about the state of capital. And I think the reliance on growth stage American capital is also inevitable today. There just isn't the quality of growth stage European capital that exists today. It might change over time with funds like Plural, who've raised large amounts of capital to back sort of more frontier technology, and they deploy sort of later than I think most traditional the early stage European firms, and hopefully more of that changes over time. But I also don't think that's wrong, right? I think if you want to build a great company, it's fine. Take all the capital and the high quality capital that you can. And the US is the largest market in the world. So I think let's not demonize the US market. I think you can build a great company in the UK. You can start building here. The talent is exceptional. But I think it doesn't need to be demonized if you take growth capital from the US, or if you launch a go-to-market strategy in the US, or sort of approach that market as well.
Wonderful. Thanks for the question. I think have we got a microphone? That's pretty cool. Anyone else want to get on the mic? This gentleman in the stripy top.
Hey there. We hear a lot about more and more capital and cash flowing into the early stage, and then on the other hand, we hear how you can get a business off the ground to 1 million ARR in 4 weeks from your bedroom, sort of thing. I'm interested in your guys' thoughts on, I guess, what the future of VC as an asset class looks like. Do we still need VC in kind of 5-10 years' time if you can build from your bedroom like that?
Who wants to take that one? Do we need you guys?
Yeah, I'm happy to take it. I mean, listen, like Mark Andreessen said it, I think very wisely, VC in a world of AI will be the last job to go. If you think about it being capital allocated to innovation, I hope he's right, and I do think he's actually right. Do we need it? No. Not in the early days most often. It depends where you sit in the stack. If you're application layer, where you can build, as we said, much cheaper, much more efficiently, no, you will need it as you scale. As you're building enterprise sales teams, as you're building security teams for large enterprise, as you're building brand, as you're building everything, yes, you need it still. But like the beautiful thing is the democratization of like starting something means that anyone can start something much more cheaply. So that's great. But then on anything deep tech or frontier AI, 100% you need cash more than ever. You need more cash than ever before. And so actually, I don't think it really changes a huge amount, but it does allow for a new economy to be built, which is like the lifestyle business, which sounds awful. I hate this like lifestyle business term. You can do a lifestyle AI business that can throw off $1 million to $10 million a year without ever going to need to raise money. And that is kind of a new economy, I think, that's being created, which is enabled.
Certainly.
Yeah, so for the deep tech stuff, you need a lot of money and you need a lot of talent, and it's not obvious that you've got product market fit or you've got anything until you've spent a lot of money. You might need to tape out a semiconductor chip and really show it before all of a sudden it's going to be a multi-billion-dollar idea. So that kind of early stage risk capital, what's happening though is that you're able to get rid of a lot more of that risk for less money. So hopefully it means that the early stage investors can do better. And then there will always be, when there are platform shifts or technology shifts, there will be people who make a lot of money very, very quickly. It happened, when the iPhone was released, there was lots of people who kind of got there quickly and made apps and got into those spaces and made a lot of money with, hardly any capital whatsoever. And I think you're seeing that now. Windsurf was acquired the other day for $3 billion. It was, was it 2 years old or less than that. Incredible amount of value creation in such a short amount of time.
But the astonishing thing with that is actually it's only really a 4-month-old product. Like they were actually doing something different for the other 2.5 years. All value creation was in that final 6 months. Crazy.
It's absolutely amazing. And those are the kind of just showing how powerful these can be. But they're just displacing a lot of the B2B SaaS companies very, very quickly and then taking a lot of value off the table. But I think that will stabilize in that layer, and then I think we'll start to see some more longer-term stuff coming through in the next year or so.
Great. Dinika?
Yeah, nothing more to add, and I think Harry said this in one of his podcasts, but our industry is bifurcating to sort of very early stage players, and then sort of the asset accumulators who are much larger stage and who act a little more as asset managers. And I believe that's where our industry is moving, and it is moving in that direction, or has kind of even moved there. In that, if you're in our industry and sort of playing this no man land of kind of doing a little bit of everything with a fund size that's not big enough, you probably won't last very long.
Yeah, I think the future of ventures like Chanel and Walmart. Chanel is a very distinct brand for a very specific customer base selling a very specific product. That's I think what we do early stage, very much a craft. And then you have Walmart, which is just a wall of money. Whatever you want, we got it, baby. $10 billion funds, you want secondaries, you want debt, you want continuation funds, you name it, we got it. And then on the startup side, it's like Walt Disney and it's Jerry Maguire. If you're an AI company, just like Walt Disney the shit out of this. Tell me a story, make it big, 99% of knowledge workers gone. Nah, we can get along with that vision. If you're not an AI company, it's Jerry Maguire, which is like, show me the money. Show me that if you're not an AI company, you need hard numbers and you need good numbers. Two different worlds.
Brilliant, wonderful. Let's have one more question. Harry, were you putting your hand up? No, you were just waving. This gentleman here in the shirt. That doesn't narrow it down, actually. A blue shirt, who'd have thought?
Hi there. In recent years, when it comes to an exit of a startup, it always seems to be an acquisition. Do you feel there's been a movement from the IPO dream that was, say, 10, 15 years ago to now it's always an acquisition from a big US firm? And how does that change business going forward?
Who wants to?
There definitely has been a shift. There's been less IPOs, they're coming back, but I think there's a lot of companies are staying private longer, and there's a buoyant secondary market. So you've got companies like SpaceX right there doing secondaries multiple times a year. So you don't need to be acquired, and I think a lot of behind the scenes, there's lots of liquidity that can be generated for early investors and founders through a secondary market. There doesn't just need to be an exit. You just won't hear about it.
The beauty of having podcasts on panels is they say like grand statements, but like, this is the death of IPOs. Like, doosh. Reason being, like, why would you go public? Why would any sane founder go public today? Why would the Collisons don't want to? Ali at Databricks don't want to. SpaceX don't want to. There's so much secondary in private markets. The liquidity is there. The lack of regulation is there. The short-termism that's focused on you when you're public is very immense. And I speak to so many public founders, 3 to 5 a week. Every single one says, I wish I wasn't public. I wish I wasn't public. Oh, I'm going through the take private. Across the board. And so why would you? And so I think that brings out a huge kind of interesting element, which is like we're seeing the biggest transition of wealth from essentially your Fidelities and your T-Rows, who traditionally the buy side or the buy book on publics, to General Catalyst and Lightspeed. And you're like, oh, okay, well, whatever. Who cares? Your grandmother cares, and all of us should care, because the 70 bips that we used to pay to Fidelity or Tira or any of the large providers, that's now going to General Catalyst and Lightspeed, except it's not 70 bips, baby, it's 2%. There's a reason the PJs are coming for them. Like, that is a lot of money. And so that is a massive transition of wealth that I don't think people are talking about. And it's going to get bigger and bigger as OpenAI do more $30 billion private rounds. Databricks does $10 billion private rounds. These are mini IPOs, but they're doing one a year. It's extraordinary. So like, I think, and then everyone's like, well, what if you're not Databricks or Stripe? Like, what happens then? Well, if you're not Databricks or Stripe and you're a $5 billion enterprise storage company, I tell you something, you don't want to be fucking public. It sucks. You're not in the index. You got to fight like anything to get an analyst to write anything about you, and you're scrutinized to hell still through regulation. You don't want that either. And so that's not a good place to be. So, death of IPOs.
Dinika, what do you think? Nothing more to add. Wonderful. Okay, well, that's a lovely note, I suppose, to wrap up on. Thanks, everyone, for coming, but thanks especially to our 3 amazing panelists, loquacious panelists, to use your
Did I get more positive as time went on? No, I didn't really. The death of IPOs is kind of a bit of a somber statement, wasn't it?
Yeah, there's an interesting graph there, but it's been very, very enjoyable and very fascinating. So thank you, Dinika Mahtani, Harry Destecroix, and Harry Stebbings for coming.